commonly used indicators. And as I mentioned, this is just for you to appreciate. Sometimes you'll come across analysis, but like most of analysts, they mostly talk about, you hear them say the price has crossed the MA 200, it has crossed. They use all those kind of language. Yeah? So it's good for you to understand what are they talking about, what is the expectation. Even if you're not relying on the analysis, just to have an understanding of what are they saying, all right? So also, you can also compare whether the analysis is in line with your own personal price action analysis. Yes, so, but you can still maybe decide, let me use these indicators, all right? They are not really wrong, only that they lag behind. They follow price. As opposed to when you use price action, you're ahead of the price. So I just said it's good to incorporate this for you to have an understanding, and you can also try them and see maybe this is what will work for you. You just need to let an indicator tell you where the market is and what you need to do, and you respond, right? So we are going to start with what we call the moving averages. This is one of the commonly used indicators. I don't think most of these analysis, you'll not miss them quoting moving averages. In short, we call them just MA, right? So a moving average is the average price of a security over a set period of time. The commonly used MAs are simple moving average, that is SMA, and the exponential moving average, EMA. So SMA, that is simple moving average, it simply takes the sum of the past closing prices over the time period and divides the result by the number of prices used in the calculation. So this is just a simple moving average. You just average the closing price over that period of time. Like if you say MA50, you're saying the closing prices for the last 50 days, you add them, all of them together, then you divide by 50. It gives you the MA50. If it is MA15, it means you take the closing prices for the last 15 days, you add them together, divide by 15 days to get the MA15. So we use the closing prices to calculate the SMA. Then we have EMA, or exponential moving average. It uses a smoothing factor to place a higher weight on recent data points and is regarded as much more efficient. So EMA is more recognized. Sorry, there's something I cannot see properly. EMA is more responsive to new information relative to SMA. Yeah, because it tries to give more weighting. You know, it is a weighted average. It gives more weighting to the most recent data than the previous one. So it responds to the most current data. So you want to look at the major uses of the moving averages. MAs are used to identify current trend reversals as well as to set up support and resistance. When a MA is heading upwards and the price is above it, the security is uptrend. Conversely, a downward dropping MA with the price below is to signal a downtrend. So today I'm not able to increase my screen, so I'm sometimes not able to see, and I'm sorry for that. So you see, conversely, a downward sloping MA with the price below can be used to signal downtrend. So when a short-term MA, for example, 50 MA, that is 50-day moving average, is above a longer-term MA, like 200-day moving average, the trend is up on the and on the other hand, a long-term MA above a short-term MA signals a downward movement in trend. So MA trend reversals are formed in two main ways: when price moves through MA and when it moves through MA crosses. So the other signal of a trend reversal is when one MA crosses through another, like 15-day moving average. So this I'm just going to demonstrate it to you in the platform. So that's enough. Short term 50 mA, and then you have the second one 200 mA. But it's best when you see it on the platform, how you pick it, how you make it long term or short term. So if the periods used in the calculation are relatively short, like 15 days and 35 days, this could signal a short-term trend reversal. On the other hand, when two MS with relatively long time frames crossover, e.g. 50 and 200, this is used to suggest a long-term shift in trend. So MS are also used to identify support and resistance levels. A move through a major MA, like 200-day MA, is often used as a signal by technical traders that the trend is reversing. Let's just see on our screen what that is all about. Before we go to the MS, allow me to just revisit an entry we did last week. If you remember, we set up some pending orders for SP500 using our ABCD pattern. The two orders were filled. You remember we had all of them, we set up, price was 29.19. The price was moving up, so it was supposed to peak, fill our orders, and start moving up. And they were filled at a very good price, the same, that is 29.19. Actually, the price went slightly below our set price to 29.17, which is good. When it doesn't move so far, it doesn't have room to hit our stop loss before it starts going into our favor. So the two orders were filled and they continued moving up. Our first TP was at 38.8, was hit at. When it is green, it tells it was closed by a take profit was hit, all right? And we got a profit of 94 rands. So when I came in, I realized the price was struggling, so I moved. Because what happens when the first one is moved, it's just good to move your stop loss to lock in some profit, so that if it moves against you, you don't lose everything, right? So I moved it just slightly below there, that 8.2% retracement. And after some time, at around 2 p.m., it was hit. When it is here in orange or pink, this is pink, not orange, sorry, colorblind. So when it is pink, it tells you it was stopped through a stop loss, but at least in profit. So if I never adjusted this, that's the importance of when the price has moved, you lock in some profit, you move your stop loss to ensure you don't give back everything. Just see where the price is right now, 2,900. So it means you'd have been close at a loss. And it's painful when you've been in so much profit, then you let your trade be closed in a loss. That's the essence of locking in some profit or moving to break even. All right, so our two trades, they went on very well, and that's good. Actually, the price never reached you see our TP was 29.35 for the second entry, but it was never hit. Today, the highest price went was 29.31. All right, which means even if I gave it time, it would not have reached our TP. That's why I say sometimes price may not always hit your TP. So it's always good to trail. You can trail manually or you set up a trailing stop, all right? And also, if you mentioned during our last class, I mentioned something about the news which were being released yesterday, okay? And I told you how the price responds to that. Yeah, we said yesterday at night, my phone is responding so slowly. Hope you can now see my new screen. It's about the calendar, the economic calendar. During our class on Tuesday, I shared with you some critical news, which was being shared yesterday, yeah? And that was about the Federal Reserve funds rate, okay? So you can see everything remained the same, but what really moved the market was the statement and the press conference, all right? The speech was more or less hawkish because the market was expecting the governor or the chairman or the president of the Powell is the what? The chairman. They were expecting him to talk in terms of planning to cut interest rates because everything was showing like the economy is sort of coming down, shrinking, and because of the GDP came lower than expected. So the expectation was he will talk about cutting these rates in the next few months or a year or so, maybe towards late 2019 or 2020. That's how market responds, even to a report, to some action will be taken maybe a year to come. Or even if today they say next year we'll raise rates by 6 times, that is enough to move the market. So their expectation was that in their speech they talk about a possibility to cut interest rates, but actually they were reluctant in that. If anything, they said, although the GDP report came lower than expected, that is transitory. It's not something which means the market, the business is shrinking or the economy is shrinking. So what happened? That gave hope to the investors of these people may actually even change everything, even with time increase rates. So that is sort of now. So they were expecting a dovish tone. We got more of a hawkish tone. So because of that, now that possibility of increasing interest rates, all right, that attracts the investors to buy the dollar. The dollar strengthened so much, like the gold really moved down. Also, that affects indices, yeah, because people will move money from stocks to buy instruments which will take advantage of the interest rate, right? So that buys, and that's why you notice also the indices, the SP 500 really dropped. Yeah, yesterday at around 10, I just checked with my phone and it was at 29.59 after all this major gapping here because of the earnings per share which were being released. But after the speech, you can see it dropped from 29.60, currently it's at 2900. What this means, when it comes to S&P 500, if you had bought at, yesterday, let's say at 10, you just saw it at that time, because of the expected news, you decide to buy. Let's say you just sold one lot of SP 500. What this move means, right? So when it moved by 60 something, yesterday it was the highest at 29.59.7. So let's say you sold that 29.59 flat, and you're still holding that position right now. If you just sold one lot of that, for S&P 500, by now you can't be having a profit of $5,000. That's why I say this thing can really make you or break you, because when it moves in your favor, it can give you good money. If it moves against you, of course, I did not trade. I just let the market be. It was a holiday, so it was just my time to relax. But those who trade, if they were able to short SP 500, there you can make good money. Just selling one lot and it moves in your favor, that you can make like 5,000, and that to trade one lot of SP 500 with FXTM, you only need to have in your account something like $600. So with roughly 2,000 to give room for the moments it going negative and all that, even 1,500, you can actually comfortably buy or sell a lot. But again, I say with SP 500, practice with time. Don't just jump into it because of money, because it can also frustrate you because of if it works against you, because again, the loss will also be big, okay? But it's something, once you learn how it works, you can comfortably trade it. Also, here with FXTM, you can just enter something like 0.1. You can see what we entered our painting orders. And to enter 0.1, you need around $63 in your account. But of course, let's talk of 100 to give room for retracements, all right? So that's basically what it is. Earlier, I was explaining about my demo account. It may look like it has a lot of money. It's a demo account, remember? But I would encourage you to trade with so much in your demo account. This figure I entered by mistake, right? So I encourage you for demo trading, try not ending more than $1,000, because once you tune your mind to practicing with a lot of money, it will not teach you the right skills, because unless you're going to fund your account with $10,000, don't practice the demo account of $10,000. Practice with something less, something which will will just prepare you to trade with that amount of money, that little money, the $1,000, the $100, you know, because at least you can start with $100. So in your demo account, just fund little, which will tune you or train you to trade with the little money, so that you train yourself just the same way you're going to, the kind of trading you're going to apply in your live account. Great. So now we go back to what you're doing, we've discussed today, and that's about indicators. All right. So when you come to your left, just before the market watch, we have navigator, and then the third now we have all the details here. All right. So indicators are here. You just expand it. Once you expand, you realize there are different types of indicators. One is trend indicators. This one will tell you more about the trend. Is it an uptrending? Is it downtrending? You know. So the trend indicators tell about the trend of the market. Then you have the oscillators. You're going to see what oscillators are about. So there are many actually. I've used most of all these: accumulation, distribution, on balance, volume. But what I came to realize, they may not be very helpful. I tried many. I took time to research, read them, apply them. But all in all, indicators are sluggish. They follow the price, and you want to be ahead of the price. But as I said, you can always try them even yourself. So moving averages, as if you recall what we were studying, is about the trend. They are under trend indicators. Trend indicators. So we look, you can see we have all this. So we've discussed about moving averages. So to put it on your chart, you just click on moving average, right click, say attach to chart, right? So here, period means the number of days you're selecting. And this exponential, we want simple moving average, all right? So we say simple moving average, apply to close, meaning they're using the closing prices. Then you say okay, all right? And it just falls into our chart. So in our discussion, we said for a simple moving average, if the price is above the MA, in this case you can see it's above, it means the price is moving up. The trend is up. It's an up trending market, which of course, as you can see, it's actually the highs are getting higher, lows are getting higher. So it definitely is an uptrending market. All right. When the price is below it, it's a downtrending market. All right. Also, what happens for those who use moving averages, they will say when it crosses, because you expect the price to go up, you should buy. Crosses coming down, you should sell. All right. But even as you can see, you can imagine how many entries it crosses, you buy. After a few minutes, it crosses back, you sell. So you also have to really time to know how you're going to trade using the moving averages. Okay. Then we talked about the crosses. This is 35. We can always change that. Right click, go to properties. Let's put it 50. All right. Then we will add another one, a bigger one. This one we'll call it 200. We'll also change the color to blue. Then we end. No, that is too blue. You cannot see it. Let me put a color you can see. Let me put that one darker. Yes, you can see that. So we also said when the small one, like the SMA 50 is below the big one, the SMA 200, the trend is downtrending, okay? And when the other one, it crosses, so it start going up, the price should be uptrending, right? You can see it crossed briefly, then it came down. So you also really have to know what you're doing to use the moving averages. Otherwise, you'll keep on selling, buying, selling, and then sometimes closing most of them at a loss. So, but most of the analysts, you'll find them using this. But works well with maybe longer time. Like you can see this 1 hour, it has been down for long. So why I say they lag behind, we said when the smaller one is below the bigger one, the trend is downtrending. So according to your analysis, you just depending on that, this will only tell you the market is uptrending the day it will cross around here, okay? It will comment when it crosses around here. Now we say the market has changed, it's now downtrending. Yet, somebody using other indicators like a double bottom or inverse head and shoulder would have identified the possible change around here and maybe entered your entry around here. After you see a proper signal of price action. So you can see you enter here at this price of 11.30. Somebody is entering once they cross over around 9.30. A very big difference of around 60 pips. That's what I mean when I say they lag behind. They respond too late, right? They follow the price. But if you're doing price action analysis, you are ahead. Yeah, you look at the price, it gives you a signal, you enter here. While some are just relying on these crosses, will wait until they cross here. This time you'll be entering around here. Actually, it's around 12.30. Because when they are crossing here, it means the price is around here, where my vertical line crosses, which is a difference of around 100 pips. Yeah, but that's how moving averages are used when they cross over each other. So you can always try to see if it can work for you. When they cross, you sell, cross the other direction, you buy, or you take your profit, then you see how it's gonna be. But basically, that's how you do. Just click. If you want to change the dates, you can also just right click on the one which is here, and then you change the date. You can put it 35 days, make it smaller than the other one, okay? They can see now these ones are close to each other. Like someone like me and you who in intraday, if you really want to use them, then use shorter time frame, like 15 and 25 or 35 and 50. Because now those ones will respond a little bit faster than the one using the 200 moving averages. The 200 moving averages, they're used mostly for the long-term traders who hold for days, months, weeks, and years, okay? But if you want to try them, then you try the smaller time frames. When the smaller one has crossed here, you sell. And you can hold and when they cross again, they go in different direction, you close and you buy again. Because you see, as long as the smaller one, the 15 is above the bigger one, 35, the trend is uptrend, all right? So at your own time, you can also try to see if this can communicate something. But if you want to use them, because we trade for short term, try the smaller moving averages, 15-day, 35-day, and 50-day, right? And I've shown you how to change the dates. So unless there's a question on moving averages, we'll move on to the next indicator. Remember, you can ask a question anytime. You're free to interrupt me, and you ask a question. Then we go to another one called moving average convergence divergence. Sorry. So this also uses the moving averages. So this indicator is comprised of two exponential MS, which is used to measure the momentum. If you recall the momentum we're doing some momentum. So it's used to measure momentum in a security. By security, just mean the instrument, either that pair or an index. So when you see security, just mean all that. It can be a pair of currencies or an index like S&P 500 or Wall Street 30. The moving average or MACD is simply the difference between these two MS plotted against a center line. The center line is the point at which the two MS are equal. Along with the MACD and the center line, an EMA of the MACD itself is plotted on the chart. Well, this may sound complicated, but you don't have to know how they are designed and all that. But you just try to describe how it is formed. But the main thing, we just want to see how it is used at the end of the day. So the idea behind this momentum indicator is to measure short-term momentum compared to longer-term momentum to help signal the trader. So when the MACD is positive, it signals that the short-term MA is above the long-term MA and suggests upward momentum. When the MACD is negative, then the short term is below the longer term and suggests downward momentum. When the MACD crosses over the center line, it signals a crossing in the MS. The most common MS value used in the calculation are the 26-day and 12-day EMA. And the signal line is commonly created by using a 9-day EMA of the MACD values. All right? So these values can be adjusted to meet the needs of the trader and the security. So for more volatile securities, shorter term averages are used, while less volatile securities should have longer term averages. So MACD histogram, as you're going to see, is plotted on the center line and represented by bars. Each bar is the difference between the MACD and the signal line, or in most cases, the 9-day EMA. The higher the bars are in either direction, the more momentum behind the direction in which the bars point. So one of the most common buy signal is generated when the MACD crosses above the signal line, while sell signal often occur when the MACD crosses below the signal line. Many stories, right? Great. Let's just see how it is done. So that's the MACD. If you can see that, that is the one shaded in red there. So the best is to explain from the chart, where you'll see it properly. That is from our MT4 platform. So if you want to remove an indicator, just place your cursor there, right click, delete indicator. All right. Right click, sorry, delete. So you want to try MACD. Yeah? MACD is somewhere down here. Attach to chart. So you can see once I place my cursor, that is MACD 12, 26, and 9. All right. So we are saying the white bars are the histograms, and they tell us about the momentum. The longer they are, the stronger the momentum going in that direction. Okay, we notice this one's quite strong. It means the market is very strong going in the downward direction. So we are saying how to use this as an indicator. Once it crosses, this is the center line, which is the 0 line. And we said this is this line is 0, it's because it is where the two MS cross each other. So the difference is 0 between the two, right? So when it crosses up, you should basically buy here, right? It crosses down, you sell, okay? So we are saying, like in this case, if I was using MA, I would have bought around here. When the MA crosses through the center line, I buy here, all right? Or I come and sell when it crosses going down, okay? So when it is negative, negative means below the center line. It means the market is downtrending. When it is positive, meaning it's above the 0 line, the market is uptrending. Of course, you can see they really mean it is true what they indicate. They are very right, they respond very well, but they lag behind, all right? And sometimes you can get, like if you're trading 15 minutes, you can find a lot of crossing, yeah? And some decisions to be, you can see like, oh yeah, you're not sure what the market is thinking, all right? It crosses back up. So do you keep on buying, selling? So also to use them, you have to do a little bit of more research, more detailed reading of exactly how can you use them effectively without just buying and selling every time they cross. Yes, so that's basically it. This program tells the momentum, and of course the momentum. They also respond. You can see that the histogram is actually longest here. Is longest here, but if me and you were to be asked, the momentum is strongest around here. Around here. So they only respond a little bit late, right? And if you are to use it, you would have saw that at around here, where the price has already moved down. So you sell here, then the price starts moving up again. You're in carrying in, you're in negative until the price comes down and crosses at the level at which you bought at. Yeah, so basically that's what I mean when I say they lag behind. But they are used actually. You'll see most of the analysts, they use this. But of course, they have gone deeper and built on them to ensure they're able to make good use of them for them to work in their benefit. And also the long-term traders, yeah, who will just be able to rely on them and hold their securities for long before they can dispose of or close their trades. So that is the MACD. You can see that when they say the inputs are here, the first EMA period is 12 days, slow EMA period is 26 days, then the signal SMA period is 9, right? You can always change this because we said for more volatile instruments, you use shorter periods. For less volatile instruments, you use longer periods. If you have any question, you're free to ask. This one, as I mentioned, I'm just mentioning for you to appreciate, especially when you come through some other analysis to know what they are talking about when they talk of the moving averages and the other indicators. Then the third one, these ones I will discuss them, two of them, they are the same. They are two oscillator indicators. That is relative strength index, yeah, which in short we call it RSI. And RSI helps to signal overbought and oversold conditions in a security. Sometimes you just read and hear this, the market it's overbought. It's always oversold. The instrument is overbought or the instrument has been oversold. Yes, so some of the indicators to signal the market that pair has gone too far. It has been overbought, which means it's likely to start going down anytime. Or it has been oversold to mean it might be the buyers could be coming in time to push it up. So the indicator is plotted in a range between 0 and 100. A reading above 70 is used to suggest that a security is overbought, while a reading below 30 is used to suggest that it is oversold. This indicator helps traders to identify whether a security's price has been unreasonably pushed to current levels and whether a reversal may be on the way. All right, so we're going to see this is RSI. Before we go to the chart, let's discuss the other one, which is called stochastic oscillator. Yeah, and you say the stochastic oscillator is plotted within a range of 0 and 100 and signals overbought conditions above 80 and oversold conditions below 20. The stochastic oscillator generally uses the past 14 trading periods in its calculation, but it can be adjusted. Okay, so these two, I want us to just cover them at the same time. Before we come to this third one, I just want to show you how to use those two. So they help us to know whether the market is overbought or oversold, or the instrument has been overbought or oversold. So if it's oversold, it only means you don't need to sell more. It means the buyers are like to come in anytime, all right? So it's just good to back off and wait for a signal to enter in the right direction. So one of them was RSI. Relative strength index. All these are indicators, and actually I've tried almost all of them. Some oscillator, accumulation, CCI, you know, I've used almost all of them. Heiken Hashi, Ichimoku. Sorry, you're looking for? Where are the oscillators? Looking for stochastic oscillator. First, relative strength index. So we say this is a it measures whether the security has been oversold or overbought. All right. And we say it is a range reading between 0 and 100. But we use mostly 30 and 70 to make decisions. So a reading above 70, like here it crossed, it means the instrument has been overbought. So it might come down anytime, right? So like if you put at day, day does not indicate, you can just go back to H. So reading above 70, the instrument has been overbought, so it might reverse anytime. A reading below 30, like it was below 30, it means the instrument has been oversold, so it might start going up anytime. And of course, you can see the market is responding. Once it crosses, buyers start coming in and start moving. Because also there are also traders who use these indicators to trade. To make decisions. It will go up again, it will hit the upper line, starts moving. Although you can see sometimes it will struggle, it can sometimes move along the line before it is pushed to start coming down. So this is relative strength index. It measures if the instrument has been overbought if it's above 70 or oversold if it's below 30. If it's below 30 means you don't need to sell. It's time to consider to buy. And actually, even you yourself, if you want to, you can actually use it. And how you do it, once it crosses 30, look for signals to reversal. You can still combine them with price action. There are people actually do that. So if it has crossed below 30, look for a signal, maybe a double bottom, an inverse head and shoulder, or even a bearish kangaroo tail. Then you can go ahead and buy. All right. So you can always incorporate if you so wish. If it crosses over again here, you can look for signal. So you can still combine it with price action if you're comfortable with that. Once it gives you that signal, then you start looking for a confirmation that the price is about to reverse. If you get a double top, then go ahead and sell. If you get a bearish kangaroo tail, you sell, because now it also confirms with the reading of the relative strength index. All right. So the other thing we saw was stochastic oscillator, and we said it also plays the same role. Stochastic oscillator also tells us if an instrument have been oversold or overbought. The same reading is from 20 to 100, but we use 80 and 20. So if the instrument is above 80, it means it has been overbought. All right. So it needs to come down. So you can see it just keeps on oscillating between those two lines. It crosses here, but again, still the reaction is it's a bit late. Okay, so you can see, like in this case, you'd have been looking to sell around here. Yet the market dropped here, but which is still okay, because even if we were to come in using our systems, we would, like the market has dropped, we draw our Fibonacci, and then here we start seeing the market is hitting our Fibonacci 38. So we also start looking for opportunity to sell, right? So this can also, you can still combine them. There's nothing wrong with that. Like the oscillators and that's the stochastic oscillator and the relative strength index. You can see they're almost behaving at the same time with the price. So you can still combine for them to give you a signal. Then once you see it's overbought, you look for a signal using your price action tools, right? So from here, you can see the price is actually struggling here. In our Fibonacci, the price has made new structure low, right? So there is no way we can sell here. We are waiting for the market to reverse, to retrace for us to sell. The same thing here, you see it is struggling at 20. Below 20 is oversold. So here the buyers are also coming in, right? So me and you, we know the market has made a new structure low. So we'll draw another Fibonacci, right? Because we don't believe in buying. The market is downtrending. Again, when the market is downtrending, you're looking for opportunities to sell. So we come and draw Fibonacci, wait for the market to start retracing. So if the stochastic oscillator, it comes and hits 80, and in our chart here, maybe it's at around 50 or 61, and we see a signal, then we can comfortably enter, all right? So you can still combine the indicators and your price action, maybe to strengthen your analysis if you so wish. Yeah, so it's just good to appreciate how they are used in case you also want to use them, and also as they use in other analysis, you can understand what the analyst is talking about. Great. So we are going to look at the last one before we move on to the next thing. But I mostly just advocate for price action, because price action, you won't go wrong. You'll always be ahead of the market. Then we'll discuss two so that we go and now discuss them on the platform. And the next is average directional index. So ADX measures the strength of a trend, but not direction. The ADX is a combination of two price movement measures. Yeah, two price movement. I think I still have to look for what can magnify for me. So ADX measures the strength of a trend, but not direction. The ADX is a combination of two price movement measures. The positive directional indicator, that is plus D1, and the negative directional indicator, negative D1. The plus D1 measures the strength of the upward trend, while negative D1 measures the strength of the downward trend. So they measure strength, no direction. Only that there is one indicator, or rather one reading, which will tell us the strength of an upward moving market. Then the other one will give us the strength of a downward trend. So these two measures are also plotted along the ADX line, measured on a scale between 0 and 100. So readings below 20 signals a weak trend, while reading above 40 signals strong trend. We're going to see that. So you can see in that chart, if you can see that, those readings, but anyway, we'll see it on the platform, to be more clearer there. Let's discuss Bollinger Bands, then I will see both of them in the platform. And you're saying Bollinger Bands, this tool adds and subtracts the standard deviation of price data changes over a period from the average closing price over that same time frame to create trading bands, in quotes. So Bollinger Bands can be used to time entry to trade. A trader might consider to take a short position when the price reaches the upper band and take a long position when the price reaches the lower band. A trader holding a long position, that is a buy, might consider taking some profits if the price reaches the upper band, and a trader holding a short position might consider taking some profit if the price reaches the lower band. The middle band always acts as a potential support and resistance. It's like a breakout when candle closes above or below it. These are how the Bollinger Bands are done, the upper, the middle, and the lower. But let's see on our charts. But in case you have any question on these indicators, please ask. Ask, even if you don't use them, if you can always ask any question, I'll be able to guide you. So that if in case you want to incorporate them, you can always incorporate them in your analysis. So we talked of average directional index, ADX. Okay, so this tells us the strength of a trend, right? And we say that reading above 40, actually this one is negative, D1 is 22, negative D plus D1 is 9. So there is the market is like a little bit undecided. None of them is over. It's above 40, all right? But you can see D1 is slightly bigger than plus D1, all right? Telling you it's more of a downtrend than an uptrend. The downward is a little bit stronger than the upward, okay? So that's how you get the readings from here. This is plus D1, reading is 9.3473, minus D1, reading is 22.96. So reading above 40 tells us that even if it's up trading, it's a strong trend. But right now, although it's down trending, it's not so strong because it's way below 40. That's the average directional movement index, or ADX. Then you want to look at Bollinger Bands. Bollinger Bands. So those are the Bollinger Bands. And we said, sorry, I want to delete this one. Bollinger Bands has 3 bands, the upper, the middle, and the lower, right? So we are saying when you can use the upper and the lower to make a decision to buy or to sell. Yeah, like here, when the market hits the upper one, you sell, okay? So when it crosses, you can see for an uptrending, the market hits the middle, it doesn't cross, it goes up. Because the market, so the lows are above the lower band, right? It's an uptrending market, the lows are getting higher, but you notice they're just sitting on the middle band, which acts as support. So this is actually like a diagonal support. Okay, if you draw this way, this becomes like a diagonal support. You can see it's in line with the middle band. Also, you can still, you can still combine it with your analysis, all right? Remember, for an uptrending market, we buy at the lows. We buy here, we buy here, we buy here. So you can actually do your analysis and you see when the market hits the middle band, all right? And you draw a Fibonacci. Let's use a smaller, smaller one is too noisy. Still using the H1, eh? Allow me to remove this trend line. So you come and draw your Fibonacci. In this case, I will draw it, the market was not making big moves. So I draw my Fibonacci there. Let me change the color of the Bollinger Bands for you to see clearly. Hey, I should be able to change the color. I don't know why I'm not. Well, let me change the width to make it strong enough for a picton 4. Now they are clear, although they are too fat, but you can still decide. Like in this case, when you look at my Fibonacci, the Fibonacci is from here to here. And when the market hit, the price hit the middle band, it was at 61.8, all right? So if you get a signal, you can comfortably buy, because also this which acts as support, you can see there is a confluence of a ratio and support, diagonal support in this case, okay? So you can actually also incorporate them in your analysis. It's still fine, right? So once you draw and they coincide there, then you get a good signal. You can go ahead and you buy or you sell, depending on the signal the market is giving you. Just a second. I want to see if I can try a smaller time frame where it can be a little bit clearer. But with the smaller ones, they make a lot of noise. With smaller time frames, you can see it crosses back up. So it would be best if you're using maybe the longer time frame. I just stick to the H1 again. So you're saying until it closes, a candlestick closes below. Once it closes below the middle band, we see there's a breakout. So the market has reversed to go to the downward direction. Okay. So again here also, if you had drawn your Fibonacci, the market came, made a new structure low here, then you do a Fibonacci. Then you notice the price is hitting the middle band at 38.2. And then the market also gives you a signal. Then we can also take it to have like sort of a confluence there. Then you sell, right? So the middle one acts as support or resistance, depending on which direction the market is in. So until the market closes outside it, like if for an uptrending market, when the candlestick closes below the middle band, now we see there's a breakout and you expect the market to start moving in a downward direction. So you sell at them when it hits the upper band, all right? And you buy when it hits the lower band. That's how we use the Bollinger Bands. Yeah, but in our case, you're going to incorporate, you'd rather rely on the middle band too, where it acts as support. As long as it's not broken out, and we say you buy at the lows. When the low comes, hits the middle band, you buy. It goes, hits the middle band again, you buy, all right? And this one I'm using for the H1, 1 hour time frame. We can also check for D1. It's a little bit more noisy also. The market came, when it crossed through here, it hits the lower band, it bounces, hits. Like here, you can see here, let me just try to show you how we can incorporate. At this level, you can see this is a daily chart. And when the price hit the middle band, it formed a very strong bearish kangaroo tail. So again, we can also say it has combined with a price action. So it's another confluence of some sort. You sell there, all right? Then you hold your position until it closes, it touches the lower band. And then we say, if you're holding a sell position, when the market is the lower band, you can take some profit, all right? So maybe you take your profit here, the market bounces back again. Again, when it hits the middle band again, you can see there was a very strong rejection. So you decide to sell again, okay? The market comes, is the lower band, you take your profit. So you can still combine the Bollinger Bands with your price action, as long as you're able to tell at what point you take what action, and what is it telling you when it reaches this level, right? So great, that's it with our indicators. Remember, we're just doing a mention, not really try to dwell so much on them. Again, here it hits a daily chart. It hit the Bollinger Band, strong rejection. The market is continuing to move down and down. So you can still incorporate. Remember these strategies, whatever we share is not the final. You can always refine and get the best for yourself. All right, refine, get the best for yourself, and still make the best use of make out the best from the market. All right. So, but I'm open for the question, whether it's about the indicators. You can ask any question anytime. I'll be able to guide you. So now we are going to the next topic, and that should be our final. So I feel we can actually finish our classes today. Then now we engage on discussions going forward. So I want us to look at risk management, right, which is like our last topic. Trading psychology and risk management. We say in Forex, your number one priority should be protecting your capital, not more of the profit, because you can make all the profit and still lose all of it plus your capital. So risk management is key. You put risk management number one more than profit. Profit comes number two, because you play defense, defending your capital. Thus, you have to first get it right with risk management, then now profit comes second, all right? And trading sometimes can have it has a lot of emotions, all right? Sometimes whether you make profit or you make a loss, your emotions are triggered in a way, yeah? If you make more profit, you feel overconfidence. Yes, I'm making it. I know what I am doing. So now because of overconfidence, you relax in your risk management, and you end up losing all the money. Also, sometimes when you make a loss, you also get emotional. You start fighting the market. You want to revenge. You want your money back, all right? Fighting the market. So you find you're no longer rational in your trading. You get emotional. So in Forex, you have to try as much as you can to control your emotions. When you feel you're not in the right state of mind, don't trade. Let it go. Yeah. There's a day I was trading and had actually grown my account from $200 to $1,000 just in one day, and I was feeling, yes, I'm getting it. And I entered a trade which I wasn't sure that I've done my analysis right, and I don't put any stop loss. But I had done my analysis right, and the market was okay. It was going in my favor, and I was comfortable, all right? And I never put any stop loss. Those are the days I could just trade without using stop loss and all that. And before long, the market was moving okay. It is the time Theresa May triggered Article 50 concerning the Brexit. So, of course, the dollar was getting stronger than the pound was really going down and down. Then all of a sudden, somebody said something. Sorry, there's a comment. Let me see. Hi, Daniel. Karibu. Welcome. You're a bit late. Sorry, I'm not sure whether I know your timing. I don't think I know the timing for Nigeria. I might have missed it, sorry. But it's okay. I've recorded. I will share the recording later. Then you can actually listen. You've only missed on the indicators. Again, we don't use them so much. But I will send you the recording. Sorry. I might have missed about the timing for Nigeria. I am not sure about your time zone. So we are saying, I was just giving a case where sometimes you can just be too overconfident, and then you start trading with emotions. You don't follow rules. You throw your rules through the window, and you're just running. So that day I began. My account just had $200, and by around 1 it was $1,000. And my plan was this day I've gone to hit around 2,000. I make a withdrawal, and I started trading without stop loss. Why? I don't know. I knew the market was working okay. The GBP is weakening, dollar is strengthening, and we are good. Then from nowhere, I had checked the news. There was nothing to really scare, whether the dollar or the GBP, so I knew I was on the right track. From nowhere, when the Trump is going to the office, he just speaks and says, no, the dollar is too strong. And when some of those people just mention about their currency, talk of Angela Merkel, if she talks about the euro, or Trump, talk about the dollar, the market just reacts like. So before long, I just saw everything running against me. My trade coming down, I'm like, what has happened? And you see these big players, they have antennas. They just capture the speeches in the air, and they're able to react very fast. And sometimes may not be a sustained move. It is just like a swing in 5 minutes. Then the market continues the same direction. But within those 5 minutes, believe you me, I lost all that. I went back to less than $200, and it's never a good feeling. It's not. If I just pushed my stop loss, I would have protected whatever I already earned, or even I had already started protecting my profit, right? So at times, emotions come in play both ways. If you make money, you get overconfidence, you throw away your rules, all right? If you make losses, again, you get emotional, you start fighting the market, you want your money back, only for you to lose more. So at the moment you feel you're not in the right state of mind to trade, just don't trade. Actually, there are days I cannot just say for a whole week. When I don't feel like, I just let it go. You don't have to trade the whole. You don't have to trade. And also, don't over trade. Because sometimes also, when you can make enter a trade, you make good profit, and you want to go back again, make more, right? Only for you to lose all what you have made, all right? So it's good to just have some kind of balance. If you've made enough, if the market gives you a good signal, it's okay, you can still continue. There are days I could actually enter trades. I count in the evening and I've traded more than 40 trades. I'm like, am I really serious? Those 40 trades, maybe 30 are losses and 10 or 15 are profits, and net, you're still not anywhere. So again, you also tie your mind. You cannot make proper decisions. You cannot think rationally, all right? So all this, you need to be careful about just controlling your emotions when you're trading. When you feel you're not in the right state, maybe there's pressure in the office, don't trade that day. Let it go. There's stress in your environment where you're trading from, Don't have to trade. Yeah, trading with emotions, it only messes you up more and more. Again, also have a trading plan. Have a trading plan and have rules, trading rules. I have my rules which I try to follow. Of course, sometimes we are human. We'll just get tempted to trade without following your rules, only for you to be hit and you're like, oh, why did I do this? So at the end of the day, I'll also share with you my rules, but you can tune them to fit your trading personality and how you, after you learn the market, how you feel it works best for you. All right, but have a trading plan and have trading rules. Trading rules is where you say, I will only enter a trade once the market retraces to that 8.2. And that's why I told you in my Fibonacci, I removed Fibonacci 23.8 because I never take trades at 23.8% retracement. It's such a small retracement, and then the risk reward ratio may not be worth it. So if the retracement does not hit 38, I let it go. It doesn't matter if it turns at 23 and become profitable. I would rather retain my capital as it is, other than just trying to chase every move and just close the day with less than what I opened with, right? So you must have your trading rules and try as much as possible to stick to your trading rules. If the rule says I will only enter a trade at 38, wait for the market. Sometimes the market is so slow. Even if it takes 3 hours to get to 38, wait for the market there. It doesn't give you signal, and I say I'll only take this kind of a signal. If there is no signal, don't enter trade, right? Once I enter at 38, my other rule is if I enter at 38 and the market starts moving against me, I will only enter, I will only average or enter additional position at 76.4%, right? Meaning I'll give the market that room. We said you can do averaging. Once you enter at 38 and the market starts moving against you, you can add positions, which you call averaging. So if you, as per my rules, if I enter at 38, then the market starts moving against me, I will only add positions if the market gives me a signal at 76.4, not at 50, not at 61, all right? But if I have not entered any position at 38, I still can enter a position at 50. So if I enter a position at 50 and the market starts moving against me, I'll only add a position if the market gives me a signal at 76. All right. So I will share with you my rules, but you can still fine tune them to work for you. So try as much as possible to follow your rules, your trading plan. Again, for me, my rule is I don't start to trade before 10. Okay, 10 a.m. South African time, because that is the time London market opens. Because before then, when Asian markets are about to close and sometimes can be very slow, between 8 and 10, you can just be there watching the screen and doing a lot of nothing. Yeah, and those moments when the market has no direction, you can actually make a lot of mistakes. So it's something I still want to just stick to. I've tried as much as not trading before 10 or thereabout. Okay. Also in the evening, there are days I could actually over trade. Come at 10, I'm still trading. 11 p.m. Until the market closes, I'm going to close. You get? So just decide which time works best for you. Stick to that time. Because when you stick to that time, you realize during that time, there is that particular way the market just behaves, right? And you fine tune your analysis and your trading as per that particular timing. There's a day I actually traded, I think, 24 hours, the whole night, trying to protect my trade. Trade was moving against me and I just want to watch it. But there is nothing you can do even if you stay there the whole night. So there are those temptations. I'm telling you because I know you'll go through those temptations of wanting to be there to ensure it is fast in profit before you go to sleep. That doesn't help. It only makes you tired, emotional, and doesn't add any value. All right. So have your trading rules and have a trading plan and follow your trading rules. Great. We look at trading psychology and risk management. There are very few laws for trading, but this is one of them. Improper risk management leads to emotional trading problems. A win or a loss, if you risk too much on a trade, you will endure emotional problems. It is not only with the losing trades that improper risk management rears its head. Improper risk management, that is risking too much on a trade, leads to emotional issues. So even if the trade is successful, so if too much risk is placed in a trade and it ends up a winner, overconfidence irrational exuberance and sloppy trade execution may be the result. I've shared with you my case. So if too much risk is placed in a trade, that ends up being a loser. Any number of results may occur. So trading rules may be ignored, psychological despair may result, and the management of the trade will almost always be exceptionally poor. So there is no way around this law of trading. So traders in a constant search for a great trading opportunity, so they seek making a profit. This is great, but not everybody is paying enough attention to another dimension of making an overall profiting, limiting the risk. So how can we limit the risk? So we look at three basic methods. One is risk-reward ratio, and I demonstrated to you how we look at risk-reward ratio, right? So the first thing in a profit, it's profit related. So the potential profit should be double or more than the risk. 3 to 1 is even better. So I will not take a trade where the risk is bigger than the potential profit. That's what I mean, the risk. I think we did that on Tuesday. We had a demonstration of how you calculate your risk-reward ratio to know if the trade is worth taking. So if you feel the risk is more than what you're benefiting, don't take the trade. Let it go. Yeah, you'd rather remain with your capital as it is than run after a trade will only make you close lower than you open the day. So this doesn't mean limiting the stop loss or extending the take profit targets in order to achieve the desired risk-reward ratio. It's a critical measure if the trader's potential or not. So if your system produces a trade that has a plausible risk-reward ratio, it's a good trade. Otherwise, it isn't. A high risk-reward ratio means that you can have more than winning ones, but still be successful in making profits in the long run. So risk-reward ratio is very important. So take trades where you feel the reward, the potential for reward is better than, if the profit was going to your favor, the profit you make is more than the loss you would make if the trade was going against you. But that will mean you'll always have a losing trade. No trader will just make profits and profits and profits. You'll always there's a trade you just go wrong. So we are saying, if you stick to the good risk-reward ratio, you may actually take 2 trades and you lose them. You close at a loss. But the third one, it may go into profit, erase all those losses, and you ensure you close at a profit than you open the day. So it's good to put into consideration your risk-reward ratios. And that's why you are saying a trade taken at 38.2% retracement, you need to take a smaller size, a smaller lot size, smaller volume than a trade taken at 76. Because taking a trade at 38.2% retracement, the risk is much bigger than a trade taken at 76.4% retracement. All right. So, and that's why I'm saying when I enter a trade at 38 and the market starts moving against me, I only add positions or average at 76. Where the risk is less, right? And I explained to you how you can actually use that to make a graceful exit for the trade you entered at 38.2%. One of the days you can actually organize to do a practical trading. The evening you do analysis, we enter a trade. As I enter, you also enter, you enter, and we see how we can look at all these scenarios. Then you are saying the method number 2 of risk management is limiting a single trade's loss according to the account size. All right. So don't say you want to trade one lot size. Yes, your account has just $200. So you have to limit the loss you can take with one trade. So basic money management means that you are aware of the percentage of loss to your total account on every single trade. A maximum loss of 2% of your account is optimal. Also, 3% can be considered. So we are saying, if your account is $100, then you do your calculations. You only need to take a maximum, maybe even 5% is okay. 5% is okay. That's how you do a calculation. But it depends. If the risk-reward ratio is so good and the signal is so strong, then you can actually sometimes take some bigger risks. Yeah, but ensure you don't over risk whatever you have in your account. Again, we are saying smaller trades in times of high volatility. You cannot anticipate breaking news, but there are quite a few known events. We saw how to look at the economic calendar. There are there are quite a few known events which result in high volatility. Like yesterday's case, the one for the rate decision by the FOMC, that's the Federal Reserve Bank of America. Also, non-farm payrolls, NFP. I never mentioned this in this class. NFP also causes a lot of movement. That is non-farm payroll report. It is released every first Friday of the month. Like in this case, I think we will check with the schedule there tomorrow. But released every first Friday of the month, and it moves a lot of movement. Sometimes they are just spikes without any direction. Just spike them, from there the market settles. So during NFP, I prefer to stay outside in the sidelines until the market settles down. Because why sometimes we find those spikes? The same time NFP report is released, also the earnings report is released. That is, the wages report is released. So if the two don't read the same direction, let's say one is red, the other one is green, depending on which traders are paying more attention to which one, the market will have no direction. More people buying, more people selling, and there's just a lot of whipsawing of the price chart. Market move up and down, up and down. So if you entered a trade, you end up being triggered at a loss. And at the end of the day, the market still moves in your favor. So I prefer to stay away, all right? Or if you must trade, then use a smaller lot size, okay? Because you expect a very high volatility. So non-farm payrolls and rate decisions, like you saw last night, are scheduled and usually rock the markets. If you plan to trade before or after these events, more caution is needed. You can tighten your stops, stay more connected to the market, and most importantly, reduce the size of the position than on calmer times, all right? I've also given an indication of, depending on your account size, what is the advisable lot sizes to take. Remember, this is not cast on a stone. You can always change it to your favor. Okay, if your account has $100 to $400, you can limit your account to 0.01, 0.02, depending. Okay, so at your own time, just check through, and you can try to practice that. So another thing to note in risk management, whatever lot size is suitable to your account, it's advisable to break the lot size into smaller sizes, okay? E.g., if your account balance is USD 500 and you would like to enter a trade of lot size 0.05, it's advisable to break it into 5 trades of lot size 0.01 each. Actually, if you notice, most of the traders do that. Even someone like, I know, Daniel, you've tried investment. You've done FXTM Invest. If you print your report, you actually realize even those successful traders, their trades are like, you can actually you're buying GBP USD, but they have done like 0.035 of them for the same pair. Why? It gives you room to have different take profits, all right? So it's good to break. You don't have to just do like one full lot size. You can actually break into 0.2, 0.25 times, so that now you're able to manage your risk better, all right? It's advisable to break it into 5 trades of lot size 0.01 each, or 3 trades with lot size 0.02, 0.02, and 0.01. This allows you to take profit at different prices and still not leave a lot on the table. So if the trades continue in your favor, or in case of a major retracement, you can reduce losses by closing some trades and still let the rest run, if you are convinced that the price will still continue in your favor. So it also gives you an opportunity to enter trades at a good price in case of retracements. Like in the case where we said, maybe you get a signal at 38.2%. You enter 0.1 and your account has $1,000, okay? Then the market continues to move against you and it gives you a signal at 76.4. You can add positions because you never exploited, all the money you can trade with when the price was at 38.2%. Also recall, like the trades we entered on Friday with you, Tim, the pending entries, we entered 2 of them. And you saw the benefit of that. One gave us a profit at a good price. Then the other one, we were able to at least lock in profit, okay, and then leave it running. So if it was continuing into our favor, it would have been for our good, we make more money, okay? If again it goes against us, we still got at a good amount of money. So it's good to break them down. You can have like 0.1, several, or 0.02, several of them with different take profits. Then you continue locking in profits to just in case the market continues moving beyond your take profit, some are able to give you more than the ones you closed earlier, right? Then you talk about emotional trading, just the story we started with. And you're saying emotional trading is the result of improper risk management. When the risk becomes too much, rational reaction to the market is impossible. If you have ever had a trade in which you took a large position, too large a position, and the trade went against you, you know what it is like to try and think when your emotions are running wild, which is very true, right? If you risk more, you cannot even settle. Sometimes if I've left a trade running and I cannot get sleep at night, I can't wait to see in the morning what happened. Why? When you have those kind, it's because you took a bigger risk for your account than what your account can accommodate. On Tuesday, I left a trade running, and that trade I was actually risking like $10. I wasn't worried. I just let it be. Yesterday morning was still there. It was in some little profit. I did not bother. I was like, if it goes against me, this is how much I'm going to lose. I'm okay with that. But if it goes into my favor, this is what I'm going to make. So when you've managed to risk properly, you will not be stressed of anything. You can let your trades run for a week, because you know whatever you're risking is something you're comfortable with. But the moment I've left a bigger, there's a day I sold Wall Street 30, and I told you this thing, they are prone to gapping. I never hold a position for Wall Street 30 or SP 500 overnight. I don't, because of gapping. You can never predict how they'll open the following day, right? Like in this case, like SP 500 and just those two. Tuesday, they gapped upwards. Last night, they gapped downwards. You get? So this day, it was on a Friday, and I knew I'm going to close it at around 9. So I let running, sometimes just leave them running. I go into my business, my whatever, Then I come and close just before the market closes. Then what happens? I came to close to realize the market has already closed. Once the market closed, you can do nothing. Believe me, I had one of the worst weekends. That is Wall Street 30 running. It can gap to almost 200 points at times, depending on what happens over the weekend. But thank God, that weekend, it gapped into my favor. When I came to check my account, I could not, because it gapped in my favor, even closing at a better profit than my take profit. Yeah, but such occurrences are rare. Don't try your luck with those two. They can gap against you, right? So when you've risked so much, you can actually mess up your emotions. Yeah, like you may not sleep. You can't wait for morning to be sure your trade operated properly. But if you just risk whatever your account can accommodate and whatever you're willing to lose, then you'll just be peaceful and let the market run. Okay? So the antidote to this is to apply proper risk management to your trades. Use a well-rehearsed set of trading rules. Trading rules are a must. You must sit down, write them. What are your trading rules? And try as much as possible to follow them. Do I have trading rules? Yes, I have. Do I sometimes breach them? Yes, I do. And of course, sometimes I pay for it. They may break, you may sometimes give me good, but sometimes they can also work against me. But when you follow your rules, and you followed your rules, even if a trade moves against you, you don't feel guilty. You don't feel like, I wish I did. No, you're okay. You're at peace because you did your analysis. You entered the trade as per your rules, and you are comfortable with the outcome. I sometimes have shared in our WhatsApp. It's what I did, it's the risk-reward ratio, and I'm okay with it. What goes against me, I'm all right. Works in my favor, I'm all right. So when you've done your analysis and you're trading within your rules, then you'll be peaceful, and you just let the market run, because you cannot control anything. You can only control the decision you make the moment you're triggering an entry. After that, the market makes the decision. So when you've done your analysis, you followed your rules, you don't have to worry about what happens next. So the number one trading skill you need to succeed as a trader is the ability to protect your trading account. This is paramount to all other goals. Protecting your account means survival. Okay? So traders who are unable to make the jump from novice trader to professional trader fail to recognize the importance of playing defense. I think we began with that. You always play defense, protect your capital. You want to make the money, but at the end of the day, protect your capital. Okay. Professional traders are very good at playing defense. All successful people share determination. Your determination will guide you to trading expertise in the form of all the hours spent in front of charts. So your determination will yield resourcefulness when it is needed most, during drawdowns and when your confidence is shaken. And your determination will help aid you to see your success before it appears. So determination is your ride to success. Let it carry you to where you want to be. So I will still emphasize proper risk management. You'd rather have your account balance stay there for a whole week because you cannot get a signal than try to, to enter many trades without a plan only for you to lose all your capital. Again, you have to start planning again, look for more money. So when you're trading, apply your rules. But number one, play defense, protect your capital. All right, great. Any question in what we've covered so far? Any question? So I know the other thing I'd mentioned you cover today is copy trading. And for this, what I'm going to do, I just want to share a tutorial I recorded on copy trading at your own time, just because it's the same thing I would cover if you were to cover today. I'll share the tutorial, listen to it. I think some of you already have the tutorial. Listen to it and ask any questions, all right? Otherwise, I think it's just good we end the class today, but we can continue discussing. We need to discuss more and more on the WhatsApp. Let me hear let me see your chart analysis, even an entry. Enter an entry in your demo and give us reasons. I entered this trade because of this, all right? So we can now discuss and see, did you do your analysis properly, okay? Because it's better you make your mistakes at the demo right now than wait to do mistakes in your trading account. But please don't go live unless you're confident. Practice with demo until you're comfortable. Remember, in demo, you can blow that account and they had you more money and you blow it even 20 times until you know what you're doing. But in demo still, practice what you've studied. Apply what you want to apply in your live account right now. Don't just play with it because it's not your money. Test the strategy we'll be discussing, try to apply it there and see how it works out for you so that you can correct anything before you go live, right? Any question? Any question regarding what we've discussed today? Or regarding anything in forward? Because I think this should be our last class. We may not have a class tomorrow, but you need to continue engaging in WhatsApp. Send your analysis, send your entries, that you continue discussing. That's the only way to learn more and more. Then one of the days, we're going to organize one evening, we do a real trading. We do analysis together from end to end. We wait for the market to get there. But I want you first to practice that. When I do that, you'll be able to follow based on what you're practicing. You need to do 1 day of live trading. We just connect and you start trading. We do our analysis and wait for the market to behave. We enter, we see what happens next. But I want you to have practiced. I don't want to do that before 2 weeks' time. For you to practice first, understand everything so that you can also have questions during that live session as we trade together. Any question? Are we together? Any question and clarification you need? Are we good? Are we ready to go? Beautiful. Ready for practice. Perfect. Perfect. But please note, you can ask question anytime. You can write a question on the WhatsApp. We discuss. Sometimes when you really want me to explain, call me on WhatsApp. I will take you through. Yeah, because I decided to just you guys pick it up and run with it successfully. So you can always even call. You need some guidance and you feel it's only a verbal direction which will actually help you understand what you're doing. You can always even guide you that on phone. WhatsApp call, you can call and then we'll be able to discuss further. Okay, thank you so much, Tim. It was nice having you in this session of class for the last 2 weeks. I've enjoyed training you, but I want us to engage further, more and more in WhatsApp. Do your analysis and share your entries. Then we're gonna discuss. So no class tomorrow. We end today, but we are going to continue discussing and practicing on WhatsApp. So thank you so much. Have a blessed evening, and we'll continue chatting more.